You are listening to Mining Stock Education.
We are not seeing a significant change in share prices of junior mining companies because investors have just become paranoid of many of these companies. And I would say even some of the good companies that I think are good and the managements are good, who are value conscious, are not benefiting from rise of gold price because an average investor has no way to differentiate between the crooks, the bad companies, the value destroying companies, and the value creating companies.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me I have Jayant Bhandari of Anarcho Capital. In our conversation today, you are going to hear Jayant's views on the current gold market, investor activism, the Lassonde Curve, warrants, and finally a few words on his conference, Capitalism and Morality. Jayant, it's great to have you. Thank you for coming on the show.
Thanks very much for having me on, Brian.
Let's start with gold. I was actually looking at the gold price chart this afternoon. It's something I don't normally do, but it was interesting because I had a conversation while I was in Argentina recently, and someone asked me about the gold price and whether we were at a top. And I thought, you know what, that's sort of interesting because I haven't really even thought of that. But when you look at the chart, it's almost parabolic. It's going right up to the right. And I was wondering for you, when you see this sort of price action in a commodity, gold or anything, does it ever concern you that you see a move this large in this short amount of time? Do you get concerned?
Well, I certainly get tempted to sell. And I was talking with someone just a while back, and I told her that she should not be selling in my view. But at the same time, there's no reason to get into this feeding frenzy. There's no reason to buy more gold at this current price. I would not be surprised, Brian, if there's a correction coming up in the next few weeks or the next few months. But at the same time, you have to have some of your money kept in something that is reliable, that is in your own pocket. Let's see, Russia-Ukraine war is not going away. The tariff wars might actually escalate. Trump might have hit Chinese the wrong way. And then you might even have a war starting in South Asia between India and Pakistan. So, the conflicts are increasing and America is not going to get involved in sorting out too many of these conflicts anymore. And for the right reason. But at the same time, the beneficiary will be gold price because local currencies will continue to depreciate. American dollar is weakening. So I'm certainly going to keep a position in gold, but I'm not going to participate in a feeding frenzy.
Right. So when it comes to those macro events that you're talking about, how much does the macro play into how you invest in the junior resource sector?
Well, when I come to investing in the junior resource sector, I am valuing those companies on the basis of valuing those companies. I'm not going to value those companies in anticipation of what might happen to gold 6 months or 2 years from now. If I did that, I would be making my thinking extraordinarily complex and I would be missing out on so many factors that I'm more likely to lose than win. So I'm going to play safe. I'm going to value a company based on factors that are inherent to that company, given a particular metal price, which is the current gold price. But then I do want to understand how this cog fits into the larger machine. And that's when I want to understand the macro environment. But usually I do these two things separately, and I don't let my views on one thing affect the other.
Excellent. Going back to the gold price, and when I used to hear the thought of or the commentary that gold was going to $5,000, $7,000, $10,000, I thought it was kind of crazy, and it still might be. And, given how we started the conversation off, it indeed might still be. But I think seeing the price action over the last year, I think I'm more open to the fact that we could see gold prices in the future, given sort of the stuff, the sort of the calamity that you're talking about with the macro events. And so I guess my question isn't as much, do you see gold going to 5,000, but are you more open to the idea of gold at those sorts of levels than you were previous, given the price action that we've seen?
Oh, absolutely. I mean, gold can certainly go up to, say, 5,000 or 7,000. But I don't buy it when people tell me that the gold is worth $50,000 an ounce. If gold were worth $50,000 an ounce, Brian, you will actually pull down the wood wall behind you and try to extract some 0.01 gram per ton of gold in that wall. And you will start making money from that. So we must also remember that the higher the gold price goes above the cost of production of gold, the more gold mines will come into production. And a lot of projects can become viable at a higher and higher gold price. So I'm not going to assume that gold price can go to $50,000 and for anything else than sheer inflation. Now, if inflation hits, then investing in companies isn't going to make you much difference because your profit margin isn't going to change much. The price of gold will go up and the cost of making gold will go up as well.
Investor activism, it's seldom talked about in the sector. And I think from my own experience, it's not something I put much thought into. I always sort of thought of myself, even though I've maybe a little bit more access to the sector than the general retail investor. I never really thought about activism in terms of how you could impact companies' direction, given that you're an investor. Both of us have had an interesting ride, so to speak, over the last couple of years with a couple of companies we've both been mutually invested in. You have taken a stance, and been very vocal about the things that were going wrong in one particular company. And you had told me a story about another one in a prior conversation. What about those situations prompted you to motivated you to come out and start speaking publicly about the sorts of things that were going on in these companies?
So, Brian, my policy is very simple. I stay away from bad people and bad companies. So most of my investments require me to assess the quality of management before I do anything else. So I am usually hoping that I'm investing in reasonably decent companies. Now, one thing is for sure, Brian, that the concept of politeness, compassion, and tolerance has become a bit. It has gone a bit wild in the West. People are sometimes over polite, over compassionate, and over tolerant. Now, I envy that thing. I'm an outsider in many ways, culturally an outsider. I immigrated to Canada, and I still envy people on the street being so nice to other people. And I wish I were the same. I wish I felt the same love for other people. But having said that, I want some accountability because unless I punish people who are criminally minded, those people will keep ramping up and psychopaths will rise in positions of power. Still, as far as investing is concerned, I'm more likely to sell my stock and move on just because usually I don't know everything. So I don't want to talk publicly about anyone until I know with reasonable assurance that that person is actually doing things criminal. Now, if we have a conversation, I'll probably very, very likely tell you the whole story so that you can make your own assessment. But with this particular group of 3 companies that you probably are mentioning, things went too egregious. I brought in institutional investors to those stories. I brought in you and some other people, and I feel bad about it that they were lying to me from day one. But the worst was that when one of those 3 companies was practically bankrupt, they were selling their own personal stock to a friend of mine at a discount to what they were raising from the market at. which meant that they shouldn't be raising money from the market anyway, but they were selling their own shares to a friend of mine, using my friendship and my so-called friendship with this company. And that made me extremely angry. Now, of course, you and I know that the exchanges are impotent. They don't do anything. There's really no, if you look closer and interact with the government institutions, they don't really work in your favor. And you realize, as Rick Rule and Doug Casey say, that the security exchanges confuse people into thinking that they are there to protect investors. They are not there to protect the investors. They are bureaucrats. They will do nothing. So yes, in very egregious cases, and I can think of 3 or 4 cases in my career that I have come out speaking against the management. And I wished more people did the same thing, because then it will become a public voice against these people. But unfortunately, Brian, that's another story, that most people stay silent and want to stay in good books of the management when those people have been abusing you. So, but then they don't see it. They just want to look nice and good.
Yeah, because I guess it brings out that fact where I think a lot of people have sort of felt that, wronged or however you want to coin it with a lot of those companies out there. And where do you have that line between being confrontational and sort of constructive? You know what I mean? Like where, you're going to make constructive criticisms or you're going to be confrontational in terms of how management is going about their work. Like how do you set that line? Like let's say G&A. G&A is a big topic where I think a lot of people, and probably including myself to a degree, aren't completely sure where that line necessarily is. You can come up with arguments and say, oh, this person's experience, their success, they should be paid X amount of money. And for me, coming from the steel industry and coming from like a practical background, I know how much regular people make in jobs that, I would say have a lot more responsibility and a lot more realness to it. So where do you, like, how can you draw that line as an investor and sort of decide, when to be confrontational, when to be constructive?
Well, when it comes to the G&A, I will have looked at that company anyway. I would have looked at the monies they are paying themselves, and I will have very likely decided to not invest in them. I am in no position to put a value on management based on the salaries they are getting. So I am ambivalent about it, except that I am unlikely to invest in a company whose management gives themselves a huge amount of money. I will talk with my friends about it, but I'm not going to go public about it. And I'm not going to invest in companies that pay themselves outrageous salaries. Also, I just mentioned to you about this group of 3 companies. Let me mention to you another company. That company wanted to go private by rolling back a stock 1 for 1,200 shares, which basically meant that that was their way to go roughshod over retail investors and destroy their shareholding to zero. Because if those shareholders did not own 1,200 shares, they would be converted. They could easily have got converted to 0 shares because of the way rollback was happening. So, and then I had to hire a lawyer. I had to talk with the exchange. The exchange is very impotent. They are very bureaucratic. So you have to hire a lawyer in that case. And then you are paying $1,000 an hour. But I was very badly stuck with that company. And unfortunately, those things happen in life. But these, I would challenge them publicly. I will take them to the law only if the flaws are so egregious that they are just in black and white.
Moving on to the Lassonde Curve, it's a topic that I don't think you and I have actually ever discussed in conversation. What are your general thoughts about the Lassonde Curve, or the idea of the Lassonde Curve, and where a company lies on it and the market's perception of the value of that company on the curve?
Well, to put it bluntly, Brian, I don't care. So I divide the mining market into two segments, or maybe three segments: the large mining companies, the mid mining companies, and the small mining companies. I tend to think and I analyze all kinds of companies, and I realize that the large mining companies tend to be overpriced, and I'm usually not interested in investing in them. Um, Similarly, medium-sized mining companies are not as overpriced, but they are more likely to be overpriced than not being overpriced. It is the junior companies that I like to invest in, where I see value mostly because other people are not really following those companies, and the big money is not interested in those companies. But when it comes to Lassonde Curve, I really don't think it makes any sense. I know a lot of people talk about it. Companies use that curve to promote themselves, and maybe they believe in it. So again, I'm not ridiculing anyone for following those companies. But imagine this thing that suppose I'm at a point in Lassonde Curve which tells me that the share price should be falling. The question is, why am I investing in that company in the first place when I already can predict the future that the share price will fall? Uh, and of course, as a market, we can't predict which way it is going, except unless you could do technical analysis or fundamental analysis. But that's a completely different curve game, not the Lassonde curve game you're talking about. Um, so yes, I completely agree that share prices can fall 90% after a while, but they can also go up 10,000% before that happens. So I don't know whether the fall will happen after it has gone 100 times, or it will go up. Fall will happen now. So again, I think Lassonde curve might make sense when you want to force fit certain companies into the curve, looking into the past, and then you avoid mentioning those companies that do not fit into that curve. So again, I don't care about Lassonde curve. Sorry, Mr. Lassonde, I have nothing against you. It's just the curve.
How about warrants? What's your thought on their inclusion in company financings? Do you think this is something that we should get rid of as a sector in the future?
I think you should. I think they are destructive to financing of companies. They are destructive to the current shareholders of the companies. Why should as a shareholder, suffer for a newbie who is not even a part of the company? He gets warrants, he gets discounted financing, and I, as a shareholder, sit outside, sit without being able to do anything. Now, Brian, having said that, I do participate in financings and I do get warrants and I benefit from those. But unfortunately, this is what I would call legal plunder. This makes really no sense to me. But also, Brian, it makes no sense to most of these companies because those warrant exercise prices pretty much put a cap on their share prices. And the share prices then often refuse to go above those warrant exercise prices. I never ever look at the warrants when I participate in the financings. I always look at the share price, and I don't think in terms of this clipping and selling shares once they come free trading and holding on to warrants. I mean, you have no skin. You really have no skin in the game. Then you don't really have to do any valuation, which means all kinds of wrong kind of people come into the financing. So I never look at the warrants. I look at the pricing, and if I like it, I participate in it. A company is currently doing financing. I told them that I did not participate in their financing last time because they did life financing, which is that these shares come free trading right away. And I think this is the ultimate in a destruction of the capital markets. But also, I sometimes think that the warrants are too cheaply priced. And then I do participate, but then I do tell the companies that, hey, if you're thinking about doing a financing, make sure your warrants are priced high enough that the current shareholders don't suffer unnecessarily.
Right. How about the counter argument? I suppose the counter argument that I've heard anyways is that the warrant is sort of the incentive to give a bulk amount of money to a company that needs it. And that is also balanced in with that 4-month hold because those shares have to be held for 4 months, that you need to give me some incentives to give you the money. Is that just hogwash, or what do you think?
Well, I prefer to quote what Warren Buffett says. He says that if he likes a company and if that company did not trade anymore for the next 20 years, he would not be unhappy about it. He would still go to sleep peacefully because he invested in value, not in a time frame. So if I thought there was value in a company, why would I worry about 4 months hold? I see no problems with that. I happily hold those companies. In fact, I don't want that hold to go away, because then all kinds of technical manipulations happen with the stock prices. Brokers can participate in shares and sell those while holding on to the warrants. So I think you encourage street smartness rather than a valuation when you enable all those kind of games. So I am perfectly happy with the hold. I actually, just going back to the life financing, Brian. There was a company that you and I are reasonably close to, certainly you more than me, and that company did life financing at the share price that the company was trading at, and they did not issue any warrant. Now, I am fine with that. I think that makes sense to me, because all they did was provide liquidity to the market without harming the current shareholders and without bribing the future shareholders. And bribing is a horrible thing, because so many people come to me and say, Jayant, hey, this company is trading at 20 cents. It's going to do financing at 15 cents. My usual response to them is, hey, if this company is going to screw their current shareholders, what makes you think that 4 months later this company is not going to screw you? But moreover, you are thinking from your greed, not from value. So you are just playing the technical game rather than valuing companies. And at the end of the day, as a portfolio of these people, they lose money because their focus is at the wrong place. They are not looking straight. They are disoriented because they are playing a game of moving money from other people's wallet to their pockets rather than doing a proper valuation, which keeps you objective and firmly footed.
What about rights offerings? Why don't we see more of them? Because it would seem to me, like your first point talking about this, it rewards people who are existing shareholders that get the chance to buy into a placement, right away, and protect, it will prevent being diluted down, and of course get the first kick at the can by being a shareholder.
I have talked with companies in the past suggesting them about doing rights financing, because that is the most equitable way of doing financing in my view. However, companies tell me that the legalities behind doing rights financings are very difficult. I'm not sure about it. I'm not a legal guy from that perspective. So that is what they tell me. But theoretically, as a concept that attracts me the most, at the same time, you are still forcing your current shareholders to give you cash when they might not be interested in giving you cash. So there's no best way of doing these things. I preferred if companies raised money at the market price without giving any discount and without issuing any warrants. I wish that were possible, but because that is not always easy and practical, you have to play around and screw some people in the process.
Which I guess it brings me to another question, is about, and it'd be on the expiration side. The more I've invested in this sector, the especially on the expiration side, I've seen how some of these deposit types do not lend themselves well for a junior to explore for or to develop. And you see, like, I think they're a pretty good contrast that I was thinking about earlier. was the contrast between a company like Rupert Resources and their Ickery deposit. And I'm pretty sure that it's well under 100,000 meters of drilling that it took them to outline this 4 point whatever million ounce deposit. Contrasted against something like a Cisco Mining's, or formerly a Cisco Mining's Windfall project, which I think had, well over 1 million meters of drilling. And it is a bigger deposit, but I think it's a good contrast to say, against, just gold deposit to gold deposit. You can see where one would have taken you millions and millions of dollars, and the other one, of course, and maybe that's partially luck, but the gold deposit lended itself more to something that a junior could somewhat handle without completely destroying the value for its shareholders. What do you think about that?
Let's look at it this way, Brian. Most of these junior mining companies are going to cease to exist because they have failed to provide value to investors. And over my career of the last 2 decades, I have seen that the junior index has fallen about 80 to 85%, and gold price, as you rightly said, has gone up exponentially. So there's something inherently wrong with many of the junior mining companies. The incentive of a lot of management is not to think in terms of whether the money they are putting in the ground is going to create value which will exceed the value they will put into the ground, the cost they will bear in drilling the hole. And there's no feedback mechanism for them. The way it works is that they promote the company and they get cash. And I think a lot of projects would be much better off being under a major company which will itself take it into production. And I think we are slowly gravitating towards it because despite the fact that gold price is at its highest ever, we are not seeing a significant change in share prices of junior mining companies because investors have just become paranoid of many of these companies. And I would say even some of the good companies that I think are good and the managements are good, who are value conscious, are not benefiting from rise of gold price because an average investor has no way to differentiate between the crooks, the bad companies, the value destroying companies, and the value creating companies. So unfortunately, that is the situation we are. I completely agree that, I'm not, again, going back to specifically to the 2 examples you quoted, I am afraid when a company is drilling far too much. Not that they should not, because to make a proper mine, you have to define the project properly. You have to define the ore body properly. But as an investor, I am very worried if that drilling is actually adding value to my share price. And as my ex-boss used to say, what you have to, Frank Holmes used to say that what you have to care about is value creation on a per share basis. I don't care if the market capitalization goes up 10 times because you might have raised 10 times money from where you started, but I don't care where market capitalization goes because that only benefits the management, not me. My benefit comes from whether value has been created on per share basis, and that is truly the best yardstick to understand the value of management on a long-term basis.
Right. And, this leads into another conversation or question in terms of project generation, because, more and more I'm sort of drawn to the project generation companies, and not all of them. But I like the business model just because of this, what we're talking about here, the fact that they can leverage other people's money to go ahead and explore and reduce that risk while retaining some of the value in terms of whether it's equity or an NSR or whatever. Do you feel the same way about project generation in terms of where it fits in the sector, or is it something again where it's sort of gimmicky and it's not necessarily the be all end all?
So let me respond to others people money concept. Again, I don't care. The fact is, Brian, that if I'm giving away 75% of the project to someone, then yes, someone is paying money to invest most of the costs of that project, but you have also lost most of the project as well. So, and other people are not being charitable, and this is the key. They are not giving you money for free. They are doing it because they are benefiting from it, which means that, as happens with insurance companies, you are losing your upside by giving away your project to other companies. Now, that said, I'm more than happy to like that approach when I get a stamp of approval. So suppose a junior mining company vends off its project to another junior mining company. It makes no sense to me usually, because now all you have is a duplication of G&A, more bureaucracy, more accountants, more legal people. But suppose Newmont comes in and participates 20% into your project. Now, I like it not because I don't, despite the fact that I'm still losing value, but because I'm getting a stamp of approval of people who are professional in mining. So that's the only reason why I might take the side of other people's money. And I think that is becoming an increasing trend with good companies, with good projects, because they need that stamp of approval to attract money from the market and the money from the retail investors. So I'm okay with that. But maybe I did not respond to your original question and I lost thought of it.
Well, I guess it's just the point I was trying to get to, in terms of how this conversation is developed, is that dilution is a big deal for a retail investor to comprehend and to understand. Certain deposit types, I think, lend themselves to being more amenable for juniors to go after themselves in terms of exploration and development. When you talk about porphyry deposits or some of these vein deposits that pinch and swell and you need 25-meter spacings, to me, it makes way more sense for you to go generate a project that has that sort, that that's the path you're going down. Then, like you said, you get that stamp of approval and you go that way with a senior company that's got the big pocketbooks and can move it forward. But of course, they're not all created equal.
Yeah. So Brian, again, I will have to do math on each company because their share prices are different, the valuations of their projects are different, the money required are different. So suppose I have to, let's say, just for mathematical purposes, suppose I have to dilute my shareholding by 100% to raise the money that will do what I want it to do. Or alternatively, I can give away 50% of my project to someone else who will invest the same amount of money on this project. Now, the thing is that the two situations are exactly the same. Now, maybe there's some mathematical issue here, but I think conceptually I have conveyed to you what I'm suggesting. Now, these two issues are exactly the same. As on a per-share basis, my ownership on the project hasn't diluted, because in one case hasn't diluted in these two different mechanisms differently, because in one case my shareholding is getting diluted by 100%, which means that I now own only half of the project, or the company can option the 50% of the project to someone else, in which case I'm still getting diluted by 50%. So again, I have to do a mathematical calculation on each of these companies, looking at their share prices and what they are doing to decide which is a better way of doing things. But then again, you also have to do a discounted valuation of this, because I just wanted to convey a concept. Now, if a company requires a $50 million investment to understand what's in the ground, and if Newmont comes in and agrees to invest $50 million over the next 2 years, these are two different games. Because a junior mining company might take 10 years to raise $50 million, whereas Newmont can decide on $50 million right away. So again, on a discounted cash flow basis, I'm much better off money coming in now and going into the ground now, so that I can make my money quickly, which is the way to do well in investing. But more specifically about generative companies, a lot of generative companies in the past got traction because of this concept of other people's money where people said that when other people are paying for it, then you are somehow a beneficiary of free money. And that is an erroneous concept, because other people are not doing charity. They are getting more than they would have got otherwise. That's why they are investing in your company. This is like an insurance company game. You are eventually actually losing value by using other people's money on your project.
You brought up an interesting point there in terms of a junior's maybe access to the large amount of money and the time it can take to develop a project or properly explore it. And, if it takes $40 million, sometimes these can stretch out to 10, 15 years. How do you gauge the pace of progression by a management team in terms of deciding whether it's a lifestyle company or it's a legit company, because it seems to be a fairly common thing that an investor should look at in the sector. Some of these companies have been around for 20 years and they really aren't that much further progressed than they were, 10 years ago. So, where's that line in terms of gauging progression?
I should never have invested in some of those companies. I did invest in them. But if a project is going to come into production 20 years from now, and if the project value 20 years from now will be $1 billion, let's say, I want that company to be trading at maybe 10 or $20 million today, so that I can, on a discounted cash flow, I will have made enough money to make up for the time duration. So that's something important to remember. But I fully understand that there are defined projects that existed 20 years back and they still continue to exist today without becoming mines. And that's a waste of money. I would hate to be a shareholder in that company. Brian, my yardstick is very simple. My yardstick is that there are ways I can make about 20 to 30% of my money every year. Now, I, of course, don't necessarily make that, but this is a yardstick I use. So unless I can apply a 20% discounted cash flow, discount value on the future cash flow, I'm not going to invest in a company. So again, as I said, if a project is going to be worth $1 billion 20 years from now, that I want to discount it by 20 years all the way today to see whether what difference would it make compared to the current market capitalization. And that should be significantly higher, at least 300-400% higher for me to take an interest in such a company.
Can you share a couple companies with us that you like right now?
Well, so this actually a good segue to what we just said. There are two companies that are, again, simple, plain vanilla, 12% upside. I'm not a greedy guy, Brian. 12% upside over the next 1 or 2 months. That's what that's becomes my yardstick, and that's the discount rate that goes into my valuation of other companies. So let me mention two simple, plain vanilla companies. One is Origin Royalties. It is merging with a much bigger royalty company, and it will get paid about $2 per share in cash. $2 per share in cash. I bought more of it today at $1.79. My upside is 12%. Now, that upside will get exercised in about 3 months' time, which means that I'm making about 4 to 5% a month on that investment. I'm more than happy with that. On an annualized basis, it very rapidly start becoming almost 100% upside if I can keep rotating my money from one company to another. And there's always an opportunity present there. So this is one opportunity, a solid company with a solid management. And I think the spin-off from Origin will be worth more than what is claimed in this $2. So the upside is more than 12% for me. Happily buying more of it right now. There's another company called Quebec Precious Metals, which is merging with another company. The merger should close in a week's time. I bought more of it today at 3.5 cents when the arbitrage value is more than 4 cents, which means that in about 10 days' time, I will have made about 10 to 15% of the money that I put into that company today. I bought 176,000 shares. You can see that on the stock watch. And this is just clean, easy money. And that should become the yardstick by which I should invest in other riskier companies. Because now I want not only this kind of discount rate, I want a risk-adjusted discount rate, which means that I want a higher discount rate applied to other companies when I invest in them.
Each year, Capitalism Morality is at the top of my list in terms of conferences to either attend or at least watch on YouTube after the fact. This year is extra special for me because I'm honored to be speaking alongside, some of what I would call my heroes in the sector, including yourself, both a friend and a mentor. Jayant, putting on these conferences, you do such a great job, but it's a tremendous amount of work. What motivates you to do the conference every year?
We started with talking about compassion, tolerance, and politeness. And I really envy when I look at Western people using those concepts so well. I actually, even a person who I don't like in the Western society, so often if I have an argument with that person, and if that person comes out with compassion and politeness, I wonder what is happening in his mind that he comes out with that kind of great values. Because I grew up in a different society. I'm scarred. I grew up in a different way. And politeness, compassion, love does not come as naturally to me as it does to a lot of European people. I'm a great admirer of Western civilization and Western values, even if I'm not someone who has all of those values or might not have all of those values in proportion that I would want to have. But I want to make Western people aware of the fact how important those Western values are, how important perhaps Christianity is for keeping and maintaining and growing a civilization. As I see, Brian, as time has passed, our Western civilization has started to fall apart, probably because some of the good things has gone off the tangent, probably. I just want to make people aware of some of the values, how important those values are, and hopefully be a part of a movement that protects the future of Western values, if not in the West, at least somewhere else. And I think it will. So that's the thinking behind it. You might call it charity, but it is something that I really believe in. It gives me a sense of fulfillment. So I wouldn't call it charity. But ironically, despite that, I never wanted to financially benefit from it. It has been a great forum to bring me in touch with some of the best brains in the world.
Absolutely. That's occurring in Vancouver. I believe it's August 23rd. We'll link to it in the description below. Jayant, as always, it's been a great chat. Hopefully we can do it again soon.
Thank you very much for the opportunity, and I'm looking forward to your speech, Brian. You are always great, and you are talking about stoicism, and that's a concept that I somehow mentally associate with you. So I'm really truly looking forward to that talk.
Well, thank you.
Yes, thanks very much.